We've got Peter Boockvar, Steve, who's Chief Investment Officer of Bleakley Financial Group and a CNBC contributor, as well as Alan Sinai, the famous Alan Sinai, former Lehman Brothers chief economist. He's now president and chief economist of Decision Economics. Thank you both for joining us. I introduced you first, Peter. So is it in the cards, a soft landing? Could the Fed just nail it and just, after all that excess for 10 years or whatever it was, all that ZERP, can we really do it and orchestrate like a 10 off the balance beam?
I think it's highly unlikely, not a surprise that I think that. I think this is a very difficult thing to maneuver because the hard soft landing is deeper than that. What happens if you have a soft landing, but it's prolonged, this recession? It's modest, but it's prolonged, because usually when you get a deep recession or hard landing, you get a very sharp snapback. The worry I have for the economy is this pernicious, and I'll use that word because it's harmful in a very subtle and gradual way, is we have multiple years of the U.S. economy having to adjust to this higher cost of capital. I mean, the private sector in the economy right now, outside of the best credits, have a cost of capital now of 8 to 12%. That is essentially double or more of what we've been used to for the 15 years leading into 2022. But it doesn't affect everybody all at once. This is going to take multiple years for debt to reprice, and that is what chips away at economic activity.
What do you think, Alan? What are your thoughts on the same subject?
You know, it's the same as it's been for a long time. We had massive demand stimulus out of monetary and fiscal policy, and the pent-up demands after the end of the pandemic, that's still stretching into the future. The rate hikes historically don't give us a recession all alone. The economy is very resistant to them. It takes all the other bad stuff that happens because of rates, like the risk, for me, 30% risk, that's what's going on in the banking system. But for the first time, almost ever, I have to give the Federal Reserve some pluses here. They've been very bad on a lot of things. Some pluses here on how they're watching the banking system, what they're doing. That's Michael Barr, and they're toning down the pace of increases. That's the right thing to do, is to space it out and do fewer of them. I do think we're going to have 2 hikes, but I'm not worried about interest rates because the economy and earnings have a lot of price level help. Are going to be very good, and we're going to hit new highs. We can do that before the end of the year.
Steve?
Hey, Joe, yeah, I just want to push back gently against my friend Peter Boockvar on this financial channel here, which I think is probably the big worry. But Peter, what I've seen is that the debt is sort of termed out, and there is time for corporate America and corporations to adjust. There will be defaults, there will be a credit cycle, but just because that happens doesn't mean it's necessarily a calamity. I think the real danger that worries me is Michael Barr and the Fed tightening lending and tightening up capital standards at a time when the banks are going through this problem. So I agree with you that you've identified the big challenge, just not clear to me that's what leads to a recession.
Well, you're right. We do have that terming out. I saw a statistic from Bank of America that of the $16 trillion of global corporate debt, and again, this would be higher quality stuff, only about 10 or 11% have repriced yet. But that is to come. But it's because of the much higher interest rate or cost of capital today versus the loans that will be coming due. For a lot of companies, that is going to be a big adjustment. And yes, there is some time to prepare for that. But when your interest expense as a percent of your debt goes to 8 or 9 from 3 to 4, well, that's a lot more cash flow that's going to pay interest expense. So yes, we can get still a soft landing, but I'm more worried about something that we're going to see more anemic growth for a prolonged period of time rather than this harder soft landing type debate. It's just going to be drawn out. It's going to take many years to sort of have the U.S. economy acclimate to this new rate world.
It's interesting. Alan, at this point, down the road for a recession, your prediction of 1 year, 2 year, 3 years, no recession at all. What do you think happens?
Look, someday we'll have one. I think it'll be after the election. We come to an election year. President Biden's been there for 50 years. It's the economy stupid. The federal government's spending a lot more money in a lot of ways. The economy is transforming to a technocentric economy. Little noticed. Intellectual property products in the GDP data. In the business side, 6.2% of GDP. And residential construction is 2.8% of real GDP. Residential construction is very interest rate sensitive. But is all this spending on the AI, the apps? Look at NVIDIA's results. There's a lot of spending going on. That is little appreciated. You add to that 71% of aggregate GDPs in consumption. Most of that services. You add to that state and local government sector spending all those monies they get on transfers. Look around you in New York, Boston, everywhere in this country, small towns, big towns. Look what's going on in construction. A lot of hiring. And look at the labor market. You can't have a recession with a fully employed, happy on the economy and happy in jobs, not happy with the way our country's going. That's why they're unhappy.
Right.
But it's good out there. It's good out there. It doesn't feel anything like a recession is here or coming. A long time away.